Hello. All right. Hello.
Hello, hello.
Hey, how's it going?
Good, good.
Why? I feel especially pixelated. Don't you think?
You look especially, I don't know what's wrong.
Let's see. See if this makes it less or more so. What do you think? I feel like I look less pixelated now.
Well, you look less pixelated. It feels like there's some light on your chest or
Yeah,
something.
that's this light is.
You need like a curtain or something. I don't know, to block
Yeah,
it.
but if I go without this light, see, let me try this one.
Yeah, that looks better for sure.
You,
Well, now you're looking
no,
pixelated like you did before.
yeah, see, that's without the light. So, I don't know what the preference is. Video. Let's see if this. Oh, let, ooh, okay. Katelyn, can you speak? Just so we're
Yeah.
checking if Matt's on the stream.
Oh, okay, awesome. So he can see it live on YouTube right now?
Correct.
Do we get to see how many are there, can you see how many people are watching?
No one's watching. It's just
Okay.
him. I can see this.
Okay, I didn't send it out to anyone.
Yeah.
I also been like hanging out with my brother and his kids at like a at their cousin's softball game.
And how was that?
Good, it was reminiscent of hanging out with you and your kids, It's a
Nice.
different from the normal thing, but it's so nice. It's such a beautiful summer.
Yeah.
Yeah.
Um. All right. I think I don't know. I don't know what's better with my video, but this is as good as it's gonna get. I think. I don't
Do
know.
you want to turn off the background and see if you just go sans background?
No, I don't think so.
Okay.
Um. All right. Well, let's get this started. Okay. You ready for this?
Yes.
All right. So this I'm calling this on the river. So these are poker terms. All in is when you go all in.
Okay.
Okay, so you push all your chips on the table. On
Yeah.
the river is when they turn over the last card and you see what comes out on the river and then you see who wins.
Mhm.
So calling this on the river all in reaction. So
Yeah.
I want to set it up a
Oh,
little bit. Oh, go ahead.
number one, first edition.
First edition, yes. So I wanted to set it up with this. So all in pod for me. I don't know about you, but I don't listen to any. I don't read any news. So I don't go to any mainstream media site. I don't go to CNN, BBC, New York Times. I don't read any mainstream news other than what comes through potentially some newsletters. So this is the closest thing I get to like a filtration of current events of like what's happening in the world. And the so like I feel like these people are people that are somewhat similar to what I am interested in, like business, technology, finance. but are kind of in current events. So this is how this shapes a lot of what I know about in the world because I don't have other access. Tell me about the role All In Pod plays in your life.
So I subscribe to Bloomberg and the Financial Times, and then
Yeah.
I'm an avid FT reader, and I'm a professional venture capitalist. So I'd say I probably have a little bit more exposure or am following what's going on, like
Yeah.
definitely in venture world. And so I probably know of the events and like have maybe like seen some of the tweets that they reference before they're referencing. For me, the value I get out of it is I think that all four of these guys are Silicon Valley insiders and they're talking pretty off the cuff. And so you're kind of getting a view into how other people are thinking who, have been at this a long time and have been successful and are probably talking to a lot of other smart people in a similar boat. So I think it's really helpful to feel like you're part of the conversation.
Yes, I totally agree. So I'll just introduce the cast of characters, and then what I'll do is play these clips, and then
Mhm.
get some instant reactions. And so basically, these guys, in my opinion, like Jason Calacanis is the moderator. He's a great moderator, and what's fun about him is like, despite him having achieved a lot independently, he's still like the utmost upward climber of all time. Like, he wants to climb upward and he doesn't. And what's great about that, it means is he has really thick skin. Like, he doesn't mind getting shat on by all the other guys because
Yeah.
they're richer than him, more financially successful. And he'll take it because he just wants to be in the room with them because it's the next level up. So he's a great moderator, but also a great punching bag. Then Chamath, he's like was early at Facebook, and then has been like claims to be the next Buffett basically in terms of managing capital. He to me really lacks self-awareness, but he is I think he's very intelligent and logical in his thinking. And he's probably the most unfiltered in terms of just saying things that come on his mind. So I find his perspectives to be interesting, but I also just think he's like the most hypocritical, where he'll do things that seem to be he does not seem to acknowledge his own mistakes or
I think he's
potential issues.
also the one who most likely has a staff of people who brief him on like a bunch of different things.
Yeah,
Versus like the other three kind of have day jobs of like very specific things that they're doing. And so he's like running almost like a family office and so can like pull up
yeah,
more than the others
yep,
professionally.
yep. We'll skip Sachs because he's not in this episode. So maybe if we for the next one, and then David Freeberg, basically he's like the science guy of this podcast, but he's really not a science guy. Like, he's a computer scientist who was a banker and then ended up starting this thing called the Climate Corporation that eventually sold to Monsanto. And he is probably my favorite on the pod, and he's basically a very rational thinker and speaker. And then there's this guest who I love. I don't know about you, but Brad Gerstner, who's from like Altimeter, and they're like a big public and private market investor. And I don't know much about him otherwise, but I just think he's a really articulate
So
talker.
I was at Capital Camp and Brad Gerstner was one of the keynote speakers there.
Yeah,
And I learned a little bit more about Brad, which was really impressive. So gosh, I can't remember the first, like he started one of the like OG internet companies back at the day or was like super early to it. This was like in the 90s or the 2000s and I wish I like knew it off the top of my head. So that like is like his first claim to fame. And
yeah.
then his most recent claim to fame is that he and Altimeter led the Series B in Snowflake, which turned and they turned like $100 million into at its peak something like 8 billion.
Oh wow.
Yeah, I
Okay.
mean, of course, like, then it like
Yeah.
it's down
Yeah. Yeah.
quite a bit, but so he's had a couple of like very large wins.
Yeah. Okay. So, anyways, these guys are all reasonably credible. I think the goal of this is to try to say like this is 2 hour podcast. They have like there's some clips in here that can kind of get you the gist of the conversation, and just to give you a perspective for people who are maybe listeners like Super Vance who want to go deeper and discuss this with other people, as well as people who are thinking about whether this podcast is something they should listen to. This is, I think, would be a good intro to kind of give you a sense, if you don't want to start from episode 1, just to pick up where they are, to understand who the characters are and what's happening, just to see if it's something for you. So I'm going to play the first clip now, and then so we'll go through each of them. So the first one's just generally about the market. So this is, again, like where I get my market news. So let's see. This is. Oh, can you enable participant screen sharing?
Yeah.
All right, ready? Here we go.
The market is on a tear this year, Brad. Is there, now that everybody's buying back into tech stocks, I guess 2 questions. Why is everybody suddenly buying into tech stocks when people think there's going to be a recession and consumers have run out of money? And yeah, what's the thinking here? Why
Arvind?
so much money has gone to tech and this incredible rally?
Yeah, can you?
It's great to watch, but
No.
People seem to be perplexed by the rally, and then the Fed, even though they
Maybe
didn't
that's
do a
fine.
rate hike, seem to put cold water on and say, hey, listen, don't get ahead of yourselves. We're going to probably do rate hikes later in the year.
We all have short memories. Tech had a devastating year in 2022. So this is a bit of a reversion to the mean, right? If you remember the chart we showed a lot on this pod last year starting at the end of 2021, was that we were trading at, multiples that were, 50 to 70% above their 10-year average. And at the trough, we were trading about 30 to 40% below the 10-year average, right? So the market corrected. It overshoots on the upside because rates went to zero. And by the end of 2022, when you had Larry Summers and others who were going out and saying, we don't know what the upper bound of inflation and rates is, that's really scary to the markets. And so you had this overshoot to the downside. We're still trading below the 10-year average for internet and software companies based upon our numbers. And so when you look at this, as we said at the end of last year, the framework changed early in this year. All of 22 was about 2 things: is inflation going higher and our rates going higher? And those things are debilitating for growth assets and growth multiples. By the beginning of this year, we started to have confidence that inflation had peaked, which meant that rates were largely in kind of, spitting distance of their final destination. And the framework shift to economy. Are we going to have a hard landing? So the NASDAQ has moved 30% to start this year. The Fed said yesterday, we're hitting pause. The quote from Chairman Powell that has everybody a little bit perplexed is, on the one hand, he says we're data dependent. On the other hand, he said we're likely to have more rate hikes, right? And that rates are going to stay high for a couple of years. Well, if we're data, you can't have it both ways. If we're data dependent, we have a hard landing like Stan Druckenmiller thinks we're going to have in Q4 this year, then rates are going to get cut. But the market seems to like this. And let's talk about where we are. The 10 years at about 3.7. The S&P is basically flat in terms of where it was and where it was before and where it was after the rate hike announcement. The economy appears to be reasonably good. 80% of earnings in Q1 beat. The guides were okay. Stan Druckenmiller said I shifted. He pulled forward when he thought we were going to have a hard landing based upon the bank crisis, which now feels like it's a distant memory for many. And he's now calling for potentially a hard landing in Q4. So the Fed just came out and said, no, we're not going to have a hard landing in Q4. We think we're going to have 1% growth. They think that inflation to end the year is going to be at 3.2% versus the 3.7% Goldman consensus. What I would say is, we've moved, but we're still below the 10-year average. But you have to start paying attention. So, I think that's where we are. And now the question really becomes, and it's unknown and unknowable, right? Are we going to have a soft landing, a medium landing, a hard landing in Q4 and rolling into next year? And I would say as an investor, I'm very data dependent.
All right. So that's the first one. So, Katelyn.
Yes.
Instant reaction here. So do you think, what do you have any macro views? Are we headed for a hard landing here? What do you think about this? Do you have any macro market views, or what do you think about?
Well, previously I used to think for sure we were headed for a hard landing, but now I'm not so sure. And I think Ventureland is definitely headed for a hard landing.
Yes.
A call of the tech, but that's not Main Street America. I think the biggest unknown for me is what happens with real estate markets and some of these much bigger indicators. But I think labor markets remain tight, and people are able to get jobs and be employed. I think they do get inflation under control. I think the question is, what happens with real estate, and will there be more corporate debt defaults as interest rates stay higher for longer than people are anticipating?
Interesting. I feel like if there isn't some sort of reckoning, then I know nothing, because it's there's it just everything that I seem to understand about the trillions that were injected into the economy, the fact that wages were stagnant, everything that all the different pieces of the puzzle, it just felt like at some point we were going to have to pay the piper. And now it feels like, yes, we have, well, I guess, higher inflation, but I don't know, the impact hasn't been that prominent yet from a consumer standpoint. And I don't know, I feel like this will have been a very mild impact if we were able to get through this without anything else.
I feel like the big impact is going to be like, so we just raised the debt ceiling, right, to beyond the next election. And I think that was like the pushing point is the government going to continue to deficit spend? Because the reason we're not, probably the big reason we're not in a recession right now is that the government has like pumped so much money into the economy and they're continuing to do so. And like none of the benefits like Social Security or Medicare have been cut back. And so people are still confident, like there's not social unrest. They're not like, no one's like lost their jobs in government. So I don't know how that shoe drops, but it definitely feels like that would be another reflection point.
Yep. Okay, so let's go to the second clip. This one is, I think, a really good discussion of the future of search. So I'll just play this, and then we can talk about what's coming there.
Well, I just had a call. Thank you, Freeberg, for putting me in touch with the Google people. I just did a call this past week with Google, and they gave me some previews of what they're working on. I can't say anything about it, but it's mind-blowing. I think Google's not as far behind closed AI as we think.
What's your read on Google now? We had a little kerfuffle when I talked about Sundar's reaction to, AI and the concerns that others might have on folks talking about the company. I mean, what's your point of view on Google today? I don't know if you talked about this.
Yeah, no. Well, I mean, I think, I had this dinner, this incredible dinner actually Thursday at the pub, and it's how I know Silicon Valley's back, because it was just like serendipitous. We threw it together in the afternoon. You had this like 4 extraordinary CEOs there, and you had Mustafa, one of the co-founders of DeepMind there, and Rich Barton from Expedia. So it's just an incredible group. And the $20 trillion question is, how does the entire open architecture of the web get re-architected in the age of AI? Another way of asking the question, because we're all kind of playing small ball, right? We're all talking about, our TPUs and GPUs, and what cloud's going to get accelerated. That's kind of the small ball. The big ball here, the $20 trillion question that has defined the entire internet for our entire careers, has been web search. And I will tell you that the conversation around that table, there's increasing confidence that whatever comes next, right, the top of the funnel is up for grabs. And all of those dollars over a period, again, of 5 years, 7 years, is going to get redistributed. And make no mistake, Google is well positioned to make its claim for that. But its claim is going to come at the expense of search. And so Google may create the best AI in the world, but it's going to have to fight off the cannibalization of core search. Every vertical search engine and Google itself, that architecture is suspect, right? The question is just over what timeline is it suspect. But the world is moving past 10 blue links. Information retrieval that looked like a card catalog is not where we're going.
You no longer need an index. You need someone to do the retrieval from the index for you. That's the new service.
And extract the knowledge and present
that's
the
what
knowledge.
It's personalized to you. But I think one of the questions that's still outstanding from an architectural point of view, in terms of your interaction with all the data in the world, is, are you as a user going to have a number of independent relationships with your travel search engine, your travel agent, or are you going to have a relationship with your doctor medical office, and you're going to have a separate relationship with your financial advisory type service? Or are you going to end up seeing, similar to the challenge we have in search versus vertical search today, an aggregator of services, because there's value in cross-populating the data and the knowledge about you across those services? So,
sure. It's going to be it's going to be the former, because obviously there's value to the company, because every company wants to profiteer from you and monetize you in 9 different ways and maximize the equity for their employees and their founders and their board and their shareholders. But that's not what people want, right? So for example, when you go to a doctor, would your doctor be better off if, she also had all of your data from, I don't know, pick your other service providers? Of course, maybe. You could make a claim that if they had all of your personal information and they understood your risk factors, they could do a much better job. But the reason you don't do that is you want some segregated relationships. It gives you some level of privacy, but mostly it gives you control. In a world of AI where you can be more conversational, the idea that humans will want to get reduced to talking to one thing for everything, I think is wrong. I think instead it's actually going to be hyper-fragmented, because the best-in-class use cases are going to be the things that people want, and then B, it gives the user control. The one thing I would tell people is, do not give up all of your data to one thing who's professing to be it all. They are going to lie to you and trick you, and you're going to have a social media problem writ large all over again.
There's another way to think about this, which is the reverse of the client-server model. where today you are the client, you are the node on the network, and you're communicating with the center of the network, which is the server, which is the service provider. And all the data sits there, and you're getting data in and out of their product to suit your particular objectives. But the future may be that more data is aggregating and accruing about you. You end up becoming a server. You then have the option. This speaks to kind of the architecture on the internet. Imagine if every individual had their own IP address, and that individual.
It's so interesting to hear him talk about this, and it's
to control,
clearly he's talking about the blockchain without wanting to mention it.
The different network service providers that you use.
That's a very smart framework, I think.
And ultimately,
but you have to agree. You want to be able to rent that data to services and have to pay for it.
I don't even think it's about rent as much as it is about you should have
the reason rent, well, then you have to rent it. You can't give it to them because that'd be stupid.
That's right. And so your goal, your usage, like let's say the doctor says, hey, can I get access to your health data, or sorry, your Apple Watch activity data for the last year? You then have the option to provide that data to them through some permission type service that you then make available. So there will be
through some permission type service,
entirely gated and controlled by the user.
Hey, on this great service, I can solve X, Y, and Z problem for you. Just give me all your data, and then if you're not asking, what do I get? And they're like, well, you're going to get a whiz bang service, and that's all they say. You're being tricked.
Can I take a crack just at summarizing what we all just said? Because your initial question was, Friedberg was like, what does this mean for Google? Well, we all just said that what we're certain of is there's not going to be 10 blue links and a model of search that they have monetized in a way that has been the most prolific business model in the history of capitalism, right? So that's a problem for them, from a business model perspective. So they're going to have to reinvent their business. That's going to be hard to do. It's like rebuilding the plane on the fly. But then if you just go to the two models that we outlined here, on the one hand, Shama said, you're going to work with all of these agents. That's exactly what Mark Zuckerberg said on Lex. He's like, you're not going to have one super agent. You're going to have, hundreds of agents. And he thinks of WhatsApp and all of his platforms as the new open web where all of these agents will live, and you'll interact with them. You'll interact with your Zillow agent there. You'll interact with your booking agent, your Expedia agent there, et cetera. On the other hand, ChatGPT, Pi at Inflection, Reid Hoffman, and Mustafa, and many others think that the benefits of general intelligence, this will be the first time that we solve vertical problems horizontally, right? And their metaphor, the compare there is we all don't have 100 personal assistants in our office. You have one that gets to know you really well. They get to know what you like to wear, how you like to travel, the things you like to eat, the things you like in your house, how many kids you have. So there's real leverage in that horizontal knowledge that can then be applied to these different verticals. I think the answer lies in between. Your personal assistant will do a lot of the general stuff, okay? Whether it's Pi, ChatGPT, whatever Googs comes up with, et cetera. But I think they will subcontract the work, whether they chain it out via, behind the scene, mechanism to other agents. So, I don't think you have to pick one or the other, but architecturally, $20 trillion of value on the web is built around web pages, advertising, and e-commerce, right? And sending traffic to those other places. And what we're all saying unequivocally is it's moving to knowledge extraction and intelligent agents. And I think that's tectonic.
Okay. So first of all, we all don't have personal assistants. I don't have either 1 or 100, so it would be nice. And 2, I think that question is a very interesting one. Like this, it does feel like even if Google might recapture this, it does feel like the entire search paradigm is in the process of being replaced. And I don't know over what time frame, but it does just cause you to think about how all the different second order effects.
Yeah, especially because the monopoly that Google has is really that you feel like you can go there and it's a one-stop shop and it will solve your problem. But very easily could you, for like travel, for example, a new brand, or even you could go back to like Kayak or Expedia and be like, okay, cool, like they have just as good or if not better quality on just travel, and so I'm going to go there.
Yeah.
I don't like, is Google going to have like a tech advantage more than any of the others? Like probably not, because you already have OpenAI and other models that you can.
Yeah. I mean, to me, like when I think about it in this frame, like it just means that to me, Google is essentially like the biggest venture fund in the world right now, with like a huge cash cow that can invest in, that has, like incredible financial resources to be able to invest in the next paradigm, but they don't have some sort of inherent advantage. Like, yes, they have some distribution, but everything else I think is much more up for grabs than I think one might be led to believe by their current dominance.
I guess they still have a lot of ad revenue and ad relationships, and advertisers are very much going to want to access these audiences, right? So
yes,
that'll be one question, is what happens with all the like ad spend. And
yes, but in terms of whether it becomes like a single agent or you're interacting with millions, like I disagree with Chamath completely, because as much as I think it would be great if we had 100 different agents that we interacted with and we siloed our data and we didn't provide I think in all cases the tyranny of convenience wins, and we'll just much rather just give no one gives a shit about privacy in their revealed preferences, so they will just give whatever data they need to for the best and most seamless customer experience. So they don't want to have to do any additional layers that are intermediate between that will not be good for the customer, or will not end up playing out.
Well, I wouldn't be surprised if this is where like the privacy and regulation actually do begin to be more powerful. So like HIPAA compliance with healthcare could really, segment out or like protect a market. And then in education, K-12, like people get very touchy if you are mixing a lot of like or making assessments about kids and their capabilities and potential disabilities, and then I wonder with like insurance, if as people start price discriminating, and there are social impacts. I mean, maybe it still is all in one, because people they're like, fine, take my data. I value convenience, but I assume that there will be some like government sort of protections.
Yeah. Yeah, I do find it very interesting now that Web3 has fallen out of favor, that they were talking around Web3 so much as they're talking about how data has to get siloed and how we're going to have to permission data, like how the new architecture of the web looks like. But despite these guys touting Web3 like up the wazoo back in 2021, it's like now I guess is it verboten or to bring up these days? So it's like they're describing it without actually using the terminology.
Yeah, well, I also think it makes Silicon Valley and technology harder if you actually believe that like it's going to be gated and it's going to be on the blockchain and people value their privacy. Because right now, I mean, all these models are relying on like artists' work, and they're ripping them off, and they're not paying them anything to like take their data. And so if they end up having to actually pay for data, that's going to totally flip business models around. Totally.
And and I don't think it's obvious that people really care about getting paid for their data.
Well, is like with like pharmaceuticals where there'll be like special tissue from like unique individuals that then end up having this massive like science breakthrough, but it's all like privatized by a pharma company.
Wait, so what is the point of that example?
The point is like maybe there's some backlash of people, or like or the population pulls for government protection, so they're like, hey, if I contribute something super valuable, like I get paid for it.
Yep. Yeah, exactly. It's got to be something super valuable. Like people don't care about the sense, the sense. I think like people conflate two ideas, which is like, okay, like the creator economy, and yes, there's some massive payouts for the Mr. Beasts of the YouTube world, but that is not the long tail of content creation and the long tail of any sort of data input where we feed into a distributed platform. The payments are just never going to be big enough or real enough for anyone to care about them compared to the benefit of the service.
Yeah, that's probably right.
All right, let's go to number 3 here, which is investing in public markets. So this is where JCal takes a beating, and I want to know what you think, whether you invest in public markets and how you view that compared to your role as a venture capitalist.
I mean, I've been doing some large searches.
JCal, how much Google do you own? Not enough.
Yeah, I've just been playing with the on my jtrading.com.
He's thinking of adding his
I'm thinking of adding $10,000. I'm like a buy-in or two. But let's pivot over to this Reddit thing, because it's super important that people understand this. I'm going to buy 17 more shares. I'm going to buy like a Harlan 2014 equivalent in shares. No, my JTrading is up right now. JTrading.com, shout out to my trades. I did it for fun. I'm at like 20% returns versus 6%.
Well, JCal, you went kind of quiet for a while. So when you're down, you don't talk about it. And
no,
then the thing comes up and you talk about it.
I liked, and I didn't want to change them.
Do you track them and exit, or what do you do with
I'm going to
management?
track the exits, but I haven't exited any. If you go to jtrading.com, you can play along.
But, JCal, how can you only be up 20% when Facebook has doubled?
Oh, sorry, 22.43.
Yeah, but Facebook doubled off the bottom. The whole goal of trading, JCal, is to maximize your highest conviction. Maximize your highest conviction. What'd you do? Put a nickel? Did you put 5% into Facebook?
I don't know. I just bought companies as they went by in the group chat. When you talked about it on group chat, I made the trade.
Companies, you got to put a lot of chips on the table. I mean, you have
that's, I think, what's the optimal number as a day trader, Brad? What's the optimal number of names I should have?
You're not a day trader. You don't trade.
As a long trader, what's the optimal number of names I should be?
You have too many. I think with your level of insight, on the things that you really believe in, there was such asymmetry in that position at the time that you bought it. It was your best idea. You should have put at least 30% of whatever you were going to allocate to this into that position.
That's what I'll do. Yeah. I mean, it's done okay. I mean, listen, I'm up. What did I buy? I bought 500 shares, and my basis is 47. I'm at 140. So it was a good trade. Yeah.
Now imagine if you could, 10 or 20x that.
Yeah, that's what I should have done. Yeah. All right.
Jason, wait, hold on. How much have you put into all those stocks?
1.5 million.
I basically I had some money in an index fund laying around, and I was like, let me do this.
1.5 million.
I did J trading as a blatant attempt to get a sponsor for This Week in Startups. So I was like, maybe Robinhood or E-Trade will sponsor this, and I'll make it like a segment.
Oh my God!
So I was like, let me do like a segment where I trade and see if I can secure the bag. And the markets are so crushed that nobody's spending advertising from Robinhood or E-Trade or Interactive Brokers or Bloomberg. But I also did it because I wanted to become better at public market trading. To your point, to last week's conversation, Jamal, is understanding when to sell and when to go long when you get distributions as a VC. That was really the reason I tried to do it, was just to try to have skin in the game. Just like learning to play PLO or you playing the RAS tournament. I just wanted to.
It's very easy. Once you get shares distributed to you, immediately sell them, and then hold on, and then re-underwrite from scratch from there.
Okay.
Once the money is sitting in your account, even if it takes a day, a week, a month, it's not like the stock's going to rip and triple on you over the next 30 days. Re-underwrite it from scratch, and then see if you have that much conviction when you see the money in your bank account.
I like it.
Okay. So, Katelyn, I thought that was very insightful, actually, Shamat's point. But obviously, there's, in my opinion, there's the only thing that's obviously ignored is the long-term capital gain, like if you sell and then repurchase. But yeah, the idea of like when you feel it in your account, then having to regain the conviction to buy is like such a strong, like your endowment bias there of like holding on to something versus then having to like rebuy it could not be more true. Okay, so tell me, what do you think? How do you view public markets what do you view your trading as?
Well, first of all, I'd say I thought they were kind of unfair on JCal because they're not like, unless you have everyone put up their trade, then no one buys at the bottom. Like no one is able to call the bottom of like a stock and then like roll it up.
Yes.
So I thought that was like really ridiculous. And then I also think,
though it's a good point to say that if your highest conviction position having 30% is again a good rule of thumb to say like, okay, when you don't want to make 100 bet if you're not trying to mimic the market, then you have to be able to make some concentrated bets. So like that's a reasonable point to make.
Yeah, but JCal said over and over again, which I think is probably true, that the only reason he's doing J trade is because he was trying to get a deal with E trade, which is more of his like core business anyway.
Yes.
Which is to my view on public market trading, which is like you can only be a professional at one thing really, and be like really, really good at it and know what you're like what thing you're amazing at. And that's where you like earn your capital to like index. So JCal's actually doing it right because his shtick is media and selling ads and doing these like brand partnerships. And so his whole lens of doing it is for his core economic model, right?
Yes.
And he's like not a public equity trader. And then it's like when you look at hedge funds, like this is the classic Warren Buffett bet, right? Like 95% have underperformed the market over a 10-year period. He does this like bet every year where he's like, hey, like here's $1 million, name 5 hedge funds that you think will outperform the market, and they never do. I don't trade public single names. I used to, but I don't anymore. And part of that is because my life partner, it's like one of the policies of his employment to that both him and now it's been expanded to significant others can't be trading.
Pelosi rule.
Yeah. And I'm sure that there must be some exceptions made because people are professionals, but I think it's been a good policy.
Yeah.
You think you're smarter than you are, or you're going to like, you have more conviction in meta at the bottom than you do. And like, you just 99 out of 100 people do not.
Yes. Yes. Okay, but yeah, in terms of the shtick, like J Cal, you're right. He's just trying to get the sponsorships. So this whole reaction, I'm just trying to do all in pod reactions until I can get Sax on to play some games of chess on live stream with me. I want to beat him in chess right here in this platform. Huh?
You think your skills are that good at chess?
I think so. Yeah, the gauntlet has been thrown. I don't know though. I may not be, but I think I could. Huh?
Are you ranked? Like, are there ratings or?
Yeah. So there's a rating, yes. And my rating currently on chess.com is like 1620, which it won't mean anything to you, but it's okay. It's not bad. Okay, so let's go to clip 4 here, which is the power of writing. So this one will be right up your alley here.
I just want to point out one thing here is the power of writing. Chamath, you decided to write your annual letter a couple years ago. Brad, you also will write a letter, famously the Facebook Getting Fit one or the Meta Getting Fit one. The power of writing is, and I just did this for the Launch Fund 4, and when you write a deal memo, compared to doing a deck, the questions you get are so qualitatively different, and the people you attract are so different. It is extraordinary. I am advising startups across the board to write really tight deal memos because we write these deal memos internally when we make an investment. But man, is it great for clarity of thought and for the person on the other side to just stop and read 1,000 words or 2,000 words as opposed to go through some stupid performative deck. It's just such a better process. Maybe you both could speak to that, or Friedberg. I don't know if you've been writing deal memos, but maybe for people who are listening who are capital allocators and founders.
I've been writing for years.
Why? And what does it do for you? Yeah.
Well, it allows you to actually find people who will critique things in a thoughtful, intelligent way. It's hard to critique decks because you use broken English, you use fancy graphics. All of a sudden, somebody that's very good at like graphical layout can dupe somebody else. And so you don't get to good outcomes because this weird groupthink effect sets in when you look at decks. So I'm not a fan of decks. I use them, but they need to be a companion to some sort of long-form narrative document. And I just think it's more useful. You get people who can really think about what they agree about, what they don't agree about. It shows the intellect of the person writing it, quite honestly. I just think it's like a basic skill that people should have. It's a useful skill to teach people as well. Decks are very dangerous, I think. If you're going to make decisions, I would encourage you, the bigger the decision, the deck is insufficient. It can be a companion piece, but it needs to be attached to long-form documents. But the long-form documents don't need to be long either. 2, 3, 4, 5 pages. But without it, I think you're going to allow some really bad decisions to creep into some good ones.
All right. First of all, I love Chamath is just so cocky. It's like he's like I've been writing for years. Okay. Yeah. Yes, everyone's been writing. Like I'm sorry, you didn't come up with writing, buddy. But
I don't think his notes are like that long either. Like
yes, he'll write these 1-page memos or whatnot, and like with bullet points. Please, but the broader point. What do you think? I mean, how do you think about decks versus deal memos, or what is the power of writing in your mind?
I mean, I think deal memos are definitely more powerful than PowerPoint decks. I just know as someone, if you're pitching someone an idea and they are not default going to sit down and read the whole thing, I know from DocSend that they spend about 45 seconds on your deck. So. Yeah. You know, if you hand them a memo, I don't think that like the average person is going to read it in depth. So I think they're two different things.
Yes. I think one is for external convincing someone. The other is for like internal clarification. I think going through the rigor of like writing a deal memo for your own investment process, for your own thinking, your clarity of thought it makes a lot of sense.
It's really easy to admit things from a deck. It's less easy to omit things from a deal memo.
Yes. Okay, so anything else on this? Okay, then the last one is this monster seed round that was announced for this AI startup. Okay, ready?
Speaking of AI funding, there was a breaking news story just in the last 48 hours. A startup named Mistral AI has raised a $105 million seed round, they're calling it. Should be at about a $240 million valuation, according to reports. One of the co-founders is a DeepMind researcher. I guess people are saying this is insane because they haven't written any code yet, and they've been working on the company for a couple of weeks.
Part of why these rounds are so big is, I guess, that you have to buy all these H100s, and they're expensive, and these rigs are very expensive. I mean, you guys saw this, that Nat Friedman basically published that he spent $75 million on a bunch of hardware, and if you were one of his portfolio companies, you could use it. So getting these H100s and A100s to train on seems to be a non-trivial task, and they're very expensive even if you can get a hold of them. So I think what we're talking about is basically that these rounds have to go up. And because if you notice, like the post, you had to raise the post so that it wasn't so utterly dilutive as to completely disincentivize the employees. But let's be honest here. Nobody's writing a $105 million seat check. That $105 million is chopped up probably 10 ways to Sunday. So there's a bunch of people putting in 5s and 10s and 15s.
I asked one of the people in the round, and they said it was massively oversubscribed.
Yeah, so it's everybody taking a little teaser bet. The problem with these teaser bets is they never hit in the way that you think. Maybe you'll get your money back with all the dilution that's going to happen, et cetera, et cetera. This is not the way to make money, guys. I'm just going to be honest with you. So whoever's putting money in thinking they know what the fuck they're doing, you might as well just light it on fire, go to Vegas and have some fun with it, because you will make more. You'll get more enjoyment from that than you will from making these kinds of investments.
What do you think, Brad?
It's dumb. Stupid.
Stupid bet? Brilliant bet?
Well, by the way, this has nothing to do with the company, nothing to do with the idea.
I'm saying, just talking about
when you're betting $4 million in a $105 million round at 240 posts, you do not know what the fuck you're doing. That is not the job.
Oh, yeah, they probably have the option to resell.
Crazy.
I do think you're right on these teaser bets. This is a power law business. There's a massive pressure on young junior partners, principals within these firms to do something.
Fire them.
It's not just teaser bets. What happens in these places is they want to get the logos because they need to explain to the LPs.
Sorry, no, actually, no, that's even worse. The GP that can't manage their fucking principal should be fired.
Right. And so
the young people should shut the fuck up, okay? Be lucky you have a job. Learn the craft. It'll take you a decade. And if you are proposing stupid bets like this, again, sizing matters. Again, I'm not talking about the company here. I'm just saying when you make a $5 million, $3 million deal memo for a $105 million round, that is stupid, okay? And so if you're the partnership that allows those kinds of things to leak through, you don't know what you're doing. So at some point, somebody should be held accountable for this.
Let me say something different. In 1997, 98, we had a similar phenomenon. Everybody thought internet search was going to be huge. There was massive FOMO and chasing, and everybody scrambled to get a search logo. Alta Vista, InfoSeek, Lycos, Go, Planet All, GeoCities, just go through the list, that people were scrambling after. And the truth of the matter is almost all those companies went to zero, even though you got a couple bets right. You got the internet right, you got search right, but you didn't have to invest $1 in search until 2003, and you would have captured 98, 99%.
Do it again now for social networking. Same thing. Do it again for social networking, Brad. Say all the names.
It's the same thing.
Same thing.
And so, when I look at it today, we have a huge anti-portfolio for AI. It's painful. We've said no to over 60 companies, right? But when we look around, I see a lot of our competitors doing a lot of these deals. Maybe they're teaser bets. I don't really know the size they're putting into those companies. But I suspect that if we believe this is as big as it's going to be and going to play out over decades, then putting a bunch of really small bets in order to buy a network or buy relationships or buy logos, et cetera, I don't think it's going to work any better this time than it worked then around social networking. But to be clear, there are going to be some people who lead these deals, who help these companies build incredible businesses.
I am an LP in a bunch of venture funds. This stuff really turns my stomach because I'm like, wow, I am losing money every day. When I see these things, that's why I get so emotional about this. I think to myself, if the GPs that I've given money to are doing these kinds of deals, I'm screwed. At best, maybe I'll get back 50 or 60 cents on the dollar. And I immediately start thinking to myself, I really need to write this down. And I'm re-underwriting that person and that organization because I'm wondering, how can you let these things happen? Because if you just look back in history, you have to be really, really negligent to not learn that these things never work out the way that you think they are. And especially these kinds of rounds and this nominal ownership, the inability to defend ownership, it's just not a path to success. Okay, Facebook's was $500,000. Yeah. We needed a lot of money later. But no, it's $5 million. Sorry, $500,000 safe at five posts.
Here's another $5 million valuation for Uber, 1.25, I think, when it just doesn't work. And we've seen this movie so many times.
But now we've gone through 18 months of nobody doing anything, I guess, in VC land. So folks on Central Road are itchy. They want to justify why they should still be drawing 2% on the full fund. They want to try to show activity so that they can raise the next fund and continue to stack fees. And all of these sort of leads to these suspension of financial logic. But it gets replaced with financial illiteracy, which is really,
why there's an optimal fund size, right, Chamath?
And this is why the people that pay the price are ultimately the LPs.
I'm going to take the other side of that.
Go ahead, Brad.
I think it's nearly impossible to conceive that all of these bets that are currently being made are bad bets. I think it's major platform disruption. But instead, I think the right way to think about it is it's about pacing. And if everybody thinks they're going to build the next Google, they're going to build the next autonomous agent that's going to sit on top of the funnel, that's going to be worth $1 trillion, and therefore they can burn $1 billion training models. That's not we're not going to have 10 of those winners. Okay. But at the same time, there's a lot of stuff getting funded that is in the application layer, that is in the tool layer. And these are not the big headlines that you're reading about, but these are really interesting businesses that are solving real problems in the software and tooling layer here. In the smaller model layer, vertically oriented things around life sciences or, targeting, financial services, or things in the application layer, like character.ai, et cetera. So I do think there are a lot of good things getting funded that will deliver real value. I don't think it's the large fund size. I think it's just a lot of exuberance to participate in what everybody perceives to be a massive platform disruption. I think that can be true, just like the internet.